Balance sheet is a financial statement that shows the financial condition of an entity as of a certain date. So why could that be important? That can be important for a couple reasons. If you have investors are going to see your balance sheet. They want to see what the entity's financial condition is. If you have a regulatory body or an oversight committee, they're going to want to look at your balance sheet, test it for financial ratios or whatever the regulatory guidelines are. If you have a bank loan, banks are going to want to look at your balance sheet and determining whether they want to lend to you or not. So those are a couple reasons you want to know what a balance sheet is and why it can be useful. So let's dive a little deeper into what a balance sheet actually is. So the first thing we want to cover is assets equals liabilities plus equity. That's the equation we want to remember with a balance sheet. Assets equals liabilities plus equity. So let's go another level deeper on that equation. Let's go assets. Assets are going to get broken down into two separate categories, current and non-current. Current assets are going to include items like cash and cash equivalents, accounts receivable, inventory, prepaids, short-term investments, trade receivables, anything that's typically going to be converted into cash within a year. Now, the other category that you're going to see is non-current assets. Non-current assets are going to include items like property, plant, and equipment, intangible assets, long-term investments, investments in subsidiaries, goodwill. These are going to be items that are not readily converted into cash within a year. So let's flip to the other side of the equation, liabilities and equity. Liabilities is also going to get broken down into current and non-current. Current liabilities are going to include items like accounts payable, accrued compensation, accrued expenses, unearned revenue, current portion of long-term debt. These are going to be amounts that are due within a year. On the flip side, non-current liabilities are going to be items that are due longer than a year. These are going to be bank loans, bonds payable, mortgages, shareholder notes. These are going to be items that are going to be financed and go out longer than a year. So next category of our equation, equity. Equity is not going to get broken down into current and non-current. Equity is going to include items like par value of stock, additional paid-in capital, retained earnings, non-controlling interest, other comprehensive income. If you're looking at an S corporation or a C corporation, which are going to be your typical business entities, you're going to see par value of stock, additional paid-in capital, and retained earnings. Par value being what you've issued your stock for, additional paid-in capital, what's been contributed over and above the par value of stock, and retained earnings, the cumulative base of your net income for the life of the entity. Now, one thing can reduce retained earnings, which is distributions and dividends. Let's discuss how to analyze a balance sheet, because you can look at a balance sheet at surface level and get a really good idea of how the entity is performing. So let's use an example of ABC Company. ABC's got a ton of cash, not a lot of accounts receivable, little to no accounts payable, a lot of retained earnings. Surface level, I'm going to be very comfortable with that entity. So is a bank, investors, anyone that's looking at that balance sheet. Let's give another example. XYZ Company. You know, I'm getting clever with these names. XYZ Company has little cash, a lot of accounts receivable, a lot of accounts payable, very little retained earnings. Surface level, not going to be that thrilled with that entity's results of their balance sheet. Want to dive a little bit deeper and ask him more questions on what the heck is going on with that company.